We have a question from Steve who asks whether bond yields are still an accurate measure of overall risk appetite since bond yields are manipulated by the massive amounts of QE that's currently going on. So thanks for the question, Steve. And it's a very valid one amidst this unprecedented amount of quantitative easing that we've seen from central banks around the world, especially the Federal Reserve. Now, as you know, government bonds, especially your high rated bonds like US Treasury notes and bills and bonds, um, are considered as one of the safest investments money can buy. And for that reason, they usually considered as the lowest risk type of investments on the market and normally considered as a very safe haven asset to hold because the US has a very slim chance of defaulting on its debts. Now, we know that one of the biggest drivers of the bond market, of course, and by extension the yields as well, is US short term and long term interest rates. Now, whenever the market thinks turbulence is ahead, the expectations for interest rates to fall will basically increase. And when that happens, bond prices will rise as demand for bonds starts to increase, which of course pushes their yields lower. And that is, of course, normally a sign of risk off. And the opposite is also true. So when expectations for interest rates start to go up, when they start to rise, we usually see bond prices fall as demand for bonds and safe havens diminish as investors seek higher yield in more risky assets like equities and commodities, or higher risk bonds in emerging markets, for example. And when that demand for bonds starts to fall, and for U.S. government bonds, and the prices fall, we see bond yields rise, and that's normally a sign of risk on. So generally speaking, lower bond yields are usually a good sign for lower risk appetite or risk off, and higher bond yields usually a good sign for higher risk appetite or risk on. Now, the challenge that Steve is pointing to comes in with quantitative easing, and a central bank like the Federal Reserve will artificially keep interest rates at the back end of the curve lower by buying government bonds in the open market with higher maturities. And we're currently seeing that happening at unprecedented scale. So the front end of the curve is, of course, kept lower by the Fed, basically just keeping the Fed funds rate low, and the lower end or the back end of the curve is kept lower by QE. Now, if this is the case and yields are artificially kept low, are bonds and bond yields still useful as a gauge for risk sentiment? Now, Steve, I would say that they definitely are. Even with the US 10-year yields at record low levels right now at 0.6%, even though they're at record low levels, yields can always go lower. And you can just look to something like Japan, look to something like Germany as an example. Yields can always go lower from where they are. And if things turn out bad enough and the economy takes another turn for the worse, then yields can go much lower from here and even go into negative territory if things get bad enough. As expectations will start to grow for the Fed to do more, um, as things get worse, the more the Fed will buy and the more portfolios will move into bonds as a safe haven. So, um, on this, there is inflation to keep in mind, obviously. If inflation starts to rise drastically, you might see outflows from bonds and see inflows into things like tips and gold as a hedge against that inflation expectations, especially if you're buying bonds at these low levels. Any drastic increase in inflation, obviously, drastically reduces the attractiveness of those bonds due to their coupon rate. So to your question, QE has definitely kept yields low and will keep them low for a while still. And even though that might mean they can move a bit disconnected here and there, the bond market will always remain a very good barometer for overall risk appetite. Sometimes seeing the warning signs long before equity markets does. And for that reason, it will remain a very handy warning sign whenever we see bond yields fall, while equities remain elevated and vice versa. It's always going to be a very good barometer for overall risk appetite, even though they are artificially kept low at this stage. So I hope that helps with the question. Steve, any other ones, please don't hesitate to let us know.